We are going to start today, however, with a conversation with Shripati Acharya, Managing Partner of Priven Advisors, which advises prime venture partners. So the conversation will be about prime venture partners. Shripati, welcome to the show.
Thank you, Shimna. It's a pleasure.
So let's get acquainted. Let's get our audience introduced to you as well as to Prime.
Sure. So Prime is an early stage tech venture fund out of Bangalore, India. That's our office. And we invest in companies which are probably the first institutional check. If I can actually make a comparison, it's probably like first round capital in the Valley. And so almost always we are the first institutional check in the company. Our goal is to support and build companies which have a core tech value proposition and as the center of their differentiation and their product offering. We can go into that a bit more during the course of our conversation. But as for me, I grew up here in India. I spent 20 years in the U.S. I was at Cisco. I was co-founder of a company called Snapfish, who's one of the early players in online photos. Then I moved to India about 10 years back. Worked, among other things, at Aadhaar, which is as a volunteer, which is India's biometric identification system, or the largest such, probably the largest such system in the world. And I had an opportunity to work there for a year and a half. And after that, we started, along with my partners, Priven Ventures. So
you said you work in core tech. How big is the fund?
Yeah, so our current fund is 70 million, Shamana.
And how do you define core tech? Are you doing core tech in the B2B context or core tech in both B2B and B2C? What is the double click down on that for a moment for us?
Yeah, that's probably like the wrong word in the one sense that tech is sort of pervading all aspects of our lives. And so what I meant to really say, I should clarify that where tech is driving a core part of the value proposition of the product, is it how your scaling is tech oriented? It could be anything from B2B to answer your specific question, wherein it is enterprise SaaS. It could be a B2C, where the value proposition, where the acquisition is digital, where the service is delivered digitally as well. So what we don't do probably is an easier question to answer, to clarify that. What we don't do is pure consumer branding, where the offline retail, all of these areas are in India are actually growing as fast, sometimes faster than many of the tech areas. But those are not areas in which we participate, primarily because that's just not our DNA of the partners. So the partners have a very operating DNA, and we think that for us to be, for it to be meaningful for us to partner with startups, it has to be something which we are passionate about and where we can add value.
Let's also double click down on your comment about writing the first check, the first institutional investors. So, I'm sure you're following what's happening globally in the venture ecosystem, especially in the seed stage. There's been a lot of fragmentation and segmentation going on, and people are even specializing within seed, in pre-seed, seed, post-seed, pre-series A, small series A, big series A, and then they have their own definitions of each of those. So in trying to understand what is your comfort zone, I guess the question that I usually ask investors is, what do you want to see by way of validation? What do entrepreneurs need to bring to you for you to want to invest in them stage-wise?
So I think really two-part question there. So onto your first one, which is, we have just so many classes of funding rounds now. In one sense, it looks fairly confusing and somewhat meaningless to actually say, what really does seed mean? So it's probably better to talk about in terms of the ticket sizes. I think that clarifies. Our A typical median ticket size might be around $1 million. But if it is a company which is really, and we have invested in a napkin stage, the prototypical napkin stage, then it's obviously going to be a lot lesser. But if it's a company which has a product, the demonstrated adoption, and probably a reasonably good product market fit, then obviously it deserves a higher ticket size and valuation. So in that sense, I would call us seed investors, because many a time companies which come to us would be funded by angels, for example. They might have had a friends and family round, they might have a small angel round. But the reason we say first institutional check is that we are fairly comfortable with ambiguity in the company. So this kind of like dovetails into your second part of your question, which is really what are we looking for? So first and foremost, really, we are looking for a thesis from the entrepreneur side, a conviction on what they are trying to build, which exhibits a 10x insight. And by 10x insight, I mean it could be 10x in terms of the value proposition from the price point of the product. It could be 10x in terms of how the product is going to get distributed out to their consumers and customers. We are looking for, or it could even be a target segment which has really not been addressed at all. It could be a completely neglected area of the market. So any of those things we are actually very comfortable with. So we are not necessarily looking for analogs like, okay, has this been done in the US or has this been done in China when we are investing. But what we are looking for is that this is solving a problem in our point of view, a real problem with a 10x insight. That's one. The second thing we are looking for, and which all VCs will talk about, is the quality of the team. And that's really a entrepreneur opportunity fit in one sense, which you're talking about. So it could be a great idea, but why you? And I think that I really encourage all entrepreneurs to answer that question for themselves.
What is your unfair advantage?
Exactly, right. And I think the unfair advantage could be, and quite often it is, hey, this is a problem I have myself faced. And those tend to be actually quite interesting, and in my opinion, some of the best companies where the entrepreneur herself has actually faced this problem and she's passionate about solving it. That's one. Usually that's good, but not enough is what I would say, because you need to also have an insight about how to solve that problem. And it is really great when we have a point of view. So as a firm, we will have a thesis about a particular space. So for example, we are very active in fintech. So we have a thesis around how this space operates. But I often say that the best entrepreneurs will come and debunk about 20% of your understanding of that space and say, hey, look, let me tell you why you're wrong on this particular area. And that is the conviction and the insight and able to prove that. And that usually is, we tried this works, but not as good as what I'm about to tell you. And this is why this makes more sense. And so that's the entrepreneur and the entrepreneur market fit. And I might add here in terms of being specific that single founders are hard companies to fund, not because they cannot pull it off, but just what we have found that even when there are overlapping skills, ideally you have at least a couple of co-founders and with complementary skills. But even with overlapping skills, having a co-founder makes for better decisions. We actually look for ideally, at least two co-founders. And then finally is the market size. And this is something which, as investors out of India, our companies can have markets in India. They can have markets globally. Actually, increasingly, companies very quickly branch out of their geography and create global companies, especially in certain areas like B2B and enterprise SaaS. But we do look for the market sizing from a bottom-up perspective. Like, how do you construct the market size bottom-up? And those are the three things which we are looking for.
So you don't necessarily need to see any product in place. You don't necessarily need to see customer traction. You're willing to, if the team, the market size, and the conviction and the concept you resonate with, you're willing to do concept financing is what I'm hearing you say. Is that correct?
That's correct. Yes, and so some of the most interesting companies actually do turn out that way. Of course, there is a
Very
higher
good.
risk and higher mortality when you do that. But I think that when the markets are expanding, it is. I don't know how to express this, but when the insight is there, you really get this aha moment. And so, you know what, I really didn't think about it that way. And of course, at that point, you would like to look for proxies to validate what they are saying is correct by talking to their potential customers or and seeing whether this value proposition makes sense. So that doesn't mean that we wouldn't want to validate it. But we are perfectly comfortable writing concept stage checks here.
Yeah, very good. That's unusual these days, and it's good that you're doing that. So geographically, you're focused on companies that are born in India, yeah?
So we are focused where the entrepreneurs are here, and I think that's correct. So they are India-based companies, but frequently the entrepreneurs will move to where their market is post.
Right.
But the reason we want India-based companies really is more what Don Valentine when he started Sequoia said, right? Which is he ideally would like to cycle to his company. That's what he said, right? And the reason is that when you're investing in early stage, you really need to have that lots of interactions and an understanding of who the entrepreneurs are. And that is very difficult, even with all the best video conferencing software we have. It's really not quite the same as a face-to-face interaction. So that is the reason why we think that it's very important to have a close proximity to entrepreneurs. Of course, as the company grows, the markets grow, and then they have to be close to the customers, and many of our companies do move.
And does that mean that you're based in Bangalore, yeah?
That's correct.
So do all the companies then need to be in Bangalore?
That's a fair point. Actually, most of our that's correct. We can't possibly cycle within Bangalore itself, given the state of our roads. But
that's true.
So what I would say is that most of our companies are in Bangalore. That is correct. We do have portfolio companies in Delhi, and so it is it is more effort really to do that, and we have to make that extra effort. But doing that across time zones in different countries is just adds a layer of complexity, which we think we are not suited to take.
Okay, very good. So now I would like to do a few examples of companies that you've invested in and are particularly excited about, and especially just to understand how you're thinking about these companies when they came to you. What did they have? How did you encounter them? And in what state did you encounter them? And what is it about them that really convinced you that, yes, these guys are going to do it and we're going to write checks? So let's do maybe 1, 2, 3, whatever number of case studies and see how you think about companies.
Sure. So let's take one company. It's called Credx, Kredx. And what Credx does is that it is an invoice discounting marketplace. So when smaller companies work with enterprises, say I am a supplier of laptops to Cisco, right?
Yeah.
So Cisco might give me there is a invoice is generated, Cisco has approved that invoice, but they might pay me after 90 days because those are the payment terms of Cisco.
Yeah.
But however, being a small SMB, I might just be a distributor of these computers, for instance. I would like to have a faster cash flow cycle. So what happens is, and this is a very standard thing, it's called invoice discounting. So you take a $10,000 invoice and say, hey, look, I'm willing to take, if I get the money now, $9,500 for that. I'm just picking some numbers. And so that's called invoice discounting. And this has traditionally been done entirely within banks, and there'll be some back rooms where this is being done. What Credx has done is brought it to retail. So I, as a individual investor, can go and participate in this marketplace and buy invoices of companies which are going to list it in the Credx marketplace. So that was the basic thing. But to come back to your question about why we invested and the stage we invested in. The stage we invested in was there are two entrepreneurs and they have this idea. really. And they had a very good detailed understanding of this idea. The product wasn't there. They were thinking about some mock-ups about this product and so forth. But they both had deep domain understanding of banking. They spent 10 years in banking each. And they said, let us explain to you how this thing works, because I was like, okay, what is this? And I've heard about it, but I really don't have an idea. And even though we are in fintech, and then they explained the whole concept with us, and we felt that they had a really deep understanding of this and a very clear understanding of how they are going to go to market. So that was a paper napkin stage investment. Now it is the largest invoices content platform in the country, and we were delighted with it, and also a category creating company, and in terms of being the first to market with this idea in India. So that was one. In general, that's why we're talking about entrepreneur opportunity fit, and this is one of those cases where this is such an involved and intricate financial product that unless you have actually worked with it, even if you are coming out from the smartest tech schools, this is not something which you'll be able to figure out. So the domain expertise does matter. Another company. Feel free to interrupt me here, Shravan. I used to think that I should talk about more. We can go on and on about our companies. Another company is a company called Quizzes. It is spelled as Q-U-I-Z-I-Z-Z, Quizzes. So here is a company which has based in Bangalore. They have an office in the U.S., but they're entirely addressing the U.S. education market. So what Quizzes provides is a platform for the problem they are solving is that for teachers it takes 10 times the amount to create a quiz than it takes for students to solve it, basically. So it might take them an hour and a half to create a 10-minute quiz. And so it is a fairly significant tax on the teachers. So what Quizzes provides is a crowdsourced quizzing repository where all different teachers all across, and their main market is the US, but they are all over the world, have gone ahead and, in one sense, the quizzes which they have created, they have contributed to the quizzes platform. And any teacher can come and then go pick up and create their own quiz. Say for, you want to teach algebra for grade 6, you can go ahead and just pick and choose and compile this quiz very easily and then administer it to their students. And so now it's grown really fast. It's in around 30% of U.S. schools, doing some 300 million questions a month. So very, very large scale, but entirely done, mostly out of India. They have an office in the U.S. as well, but it's a small team. And what we really liked about it is that it was actually making the lives of the teachers better, and in one sense also helping the students in the process, because students could go back and they could retake that quiz and understand which are the areas which are different. Anyway, so that was another one. Again,
on this one, Shripati?
So the problem which they are solving is that they are providing a platform for teachers to quickly create and administer a quiz in the classroom.
Yeah, I got that. What is the business model?
So the business model here is actually going to be the parent-based, right? So now the students are beginning to do their quizzes from home to start their own quizzes because they want to practice. And so in education you can do only two ways, right? You can either charge the teachers or you can charge the parents for this. And this is a great way for Quizzes now, Quizzes a company, to go ahead and monetize the parent through a monthly subscription to the platform, something like that. So monetization is just the process is beginning now. So they came to us when, in this particular case, they actually had the product. They had the product and they were seeing very, very initial. They might have had maybe 100,000 questions in total solved on the platform. Today they have 1 billion questions solved on the platform over that. But they came to us when they had maybe launched it for a month, this particular thing. Mm-hmm. But what we really liked about it is that they really had a visceral understanding and a connect with the teachers. Mm-hmm. Because they really understood.
Did they have teaching background?
No, they didn't. So this is the interesting thing. And so that's why, what I realized is that the best way to approach a company and a startup and the entrepreneurs is to be not really prejudiced about it, because you end up learning something. In this case, there are two folks with deep technical backgrounds, at Amazon and similar companies, but somehow they are just nuts about education. So they had gone ahead and created a game about math, wherein there were wizards who were going and killing demons and things like that, which had a lot of traction. But the challenge was that how do you keep continuously creating content? So then they actually crowdsourced the content creation, and suddenly they had a, essentially infinitely scalable model. But they had the same connect with the teachers and the students, which is let's actually make the teaching better. So that's how this whole thing came about.
So in a situation like that, when you're evaluating an investment opportunity, the monetization, this one, not the previous one, this one, the monetization is unproven, and it's a thesis, it's a hypothesis. You're assuming that parents are going to pay. How much of that kind of risk are you willing to take?
So that is actually the hardest kind of risk to take. I think that's very is spot on your question about that, because what you're taking is a business model risk. And the business model risks are hard because it's out in the future, and it's like shooting at a bullseye, and you're like with a rifle, but you're like a kilometer away. So it is a higher degree of risk. And to the extent possible, we need to have at least some idea about some evidence that this thing could work. But in this particular case, that was a risk which we took, and we felt that the way in which they were acquiring, folks who were increasingly using their platform demonstrated a deep insight about how to work with teachers and how to deliver value to students. And if you build it, they will come. Basically, that will figure out a viable way in which the users would be able to do it. And I think that's a risk we continue to have, right? I think that until there is sufficient monetization with any such company, as risk capital, I guess we just have to take it.
I think what I'm observing in the way you're talking about your investments is that you have actually more risk appetite than many of your peers, which is interesting because, as you know, in your business, everybody wants to do things that are already proven and validated to a large degree, including paying customers. So I think because of your mindset, you may be able to bring to fruition innovation that cannot be proven so quickly. It will take a bit of time to build out certain amounts of certain types of innovation and monetize and so forth. So it's good that you have that appetite. Now I'm going to switch the line of questioning a little bit to what is your philosophy about how much capital are you comfortable with a company or a concept needing to become successful? Because we are in an era where there is this unicorn chasing going on with companies flushed with capital and on the one extreme, and then in comes SoftBank and flushes the companies with more capital, and some of the early stage investors exit and so on and so forth. Even the entrepreneurs often exit part of their holdings in those rounds. On the other extreme are investors who recognize the fact that you can build companies very capital efficiently today, and more applying the bootstrapping principles, and in some cases, bootstrapping to exit opportunities are arising where you make a very, very good return on certain investments as long as you build them in a capital efficient manner. Most of the enterprise exits, if you talk about the enterprise software world, most of those exits happen in the sub 50 to 60 million exit price range. So to make money off those kinds of exits, that means that you're going to have to build these companies for under $5 million, $10 million. So where in this, continuum do you sit from your philosophy point of view, and how much money do you like your companies to need?
So I think that so it's very easy, at least folks like SoftBank are like funding companies which are much later stage. So it's really a growth capital, and just a different philosophy and a different way of evaluating those opportunities. Much more financial analysis at that point. The point where we come in, we are looking for what is it that you need to get to the next stage, and it's super important to not overcapitalize the company for a couple of reasons. One, of course, I mean, these are things which venture capitalists, and I don't know if entrepreneurs necessarily believe it or not, but I was talking yesterday to an entrepreneur who was actually talking exactly about why they actually turned down raising a lot of money. And I think one is that the structure of the company changes. Once if you raise 10 million instead of 3, let's say. And because sometimes there are opportunities like that because you have a oversubscribed round, there is a lot of interest in a particular area, and so now you have you get overcapitalized companies. So one, immediately the cost structure of the company changes instantly because the entrepreneur in one sense is obligated that they need to be spending that or investing that money in order to provide returns. And entrepreneurs will also be asking you to sit on that capital for years together that, hey, what are you doing with that? So it leads to a greater cost structure. So we feel that that's one. And the second thing is that it reduces the innovation within the company. I especially feel it for companies, for example, in let's take a B2B case, like an enterprise SaaS. When you're starting out in enterprise SaaS, you just like overfund the company. The first thing you'll go and do is, even without actually understanding, completely building the product, you start hiring sales. And the thing is that once you do that, your cost structure instantly shoots through the roof because you can spend a lot of money before product market fit very quickly because you're actually not getting revenue.
Product market fit.
Sorry?
Salespeople cannot achieve product market fit. Product market fit has to be engineered by the entrepreneurs with very deep conversations with a select group of customers. Bringing in salespeople early is completely useless.
Absolutely. And I think we see those kinds of mistakes occur. So we think that capitalizing a company max from 18 to 24 months of runway, with the first 6-12 months, like actually being very frugal, even if you have a lot of money in the bank, until you get product market fit. And it's one of those things that customers, entrepreneurs sometimes ask, how do I know there's product market fit? You really do know when there's product market fit because you just start running out of people or products to actually service those requests. Yeah. And you have that energy in the company because now the customers are constantly asking, they're using the product even though it's broken, et cetera, et cetera. So I think that it is in early stages, I think it's a great way to actually mess things up by overcapitalizing the company. Strongly believe that.
I imagine the philosophy that you've described earlier of being willing to do deals that are almost napkin stage deals. You don't see as many subscribed rounds because there are not many investors in India, especially, who are willing to do that. Actually, globally, there aren't that many investors who are willing to do that. So that almost shields you from that problem, isn't it?
It does. I should clarify that not all, of our investments are in that range. Many times they will have a product and, as I said, an initial indications of product market fit as well. But what we have found is that in many cases, it requires a lot of understanding and discussion to figure out what this play is about. And that requires patience. So actually, napkin stage deals don't get done in an instant over a cup of coffee, at least not in our book.
No.
You actually need to spend time to understand what's going on here. And so in one sense, the entrepreneurs end up choosing the VCs as much as VCs are choosing the entrepreneurs. Because they're trying to understand, hey, do you understand what I'm saying? And many of the deals which we have done, the entrepreneurs said, hey, look, we couldn't really get our point across to some of the other folks which we are talking to. And that could be for any number of reasons. And people have different points of view, and that's why you have different VCs out there. And so I think that understanding, like, what is it that we are after, what is the bet we are actually making, is not as obvious, especially in early stages. And sometimes the entrepreneurs have a general idea, but even they need to refine it before we go ahead. It's okay to make a bet and be wrong on it, but and I feel that it's also okay to be proven wrong quickly. It's a lot better. And if you don't have your hypothesis somewhat clear, it's very easy to meander around.
Yeah. Well, the other thing that makes it difficult for entrepreneurs who are thinking really contrarian is that the market behave differently. Everything signal in the market is against you. So if you're taking a contrarian position, then I know I have taken a contrarian position with 1 million by 1 million, and there's a lot of people who hate my guts for doing that.
Yeah, I think that that's why the conviction of the entrepreneur is really important, and you wouldn't be at 100,000 folks, 400 podcasts, and interviews until you had a deep conviction about it. And I think that is super critical if you're going to kind of take the path not taken.
All right. Well, great conversation, Shripati. Thank you for coming and sharing your firm's point of view and explaining what you like to invest in. I hope we'll find things to work on together.